Welcome everybody. Thank you for attending this panel. I'm conscious that we've had a very big hitters one down, the CEO roundtable downstairs, so thank you for kind of rushing upstairs for this. As David says, I run Fair Exchange. We specialize in data analytics, execution analysis in foreign exchange markets. And my background, before I set up Fair Exchange, I ran the e-sales business at Morgan Stanley. So I've got a little bit of experience about institutional EFX, but I'm sat here with a very distinguished panel of people who I'm going to ask a few searching questions about their thoughts on this. So, Tom, why don't we start with some introductions with you?
Hello, my name's Tom Higgins, and I'm CEO and founder of Goldeye. We're an 11-year-old fintech company. We've initially operated in the retail market space, but recently we've moved more into the institutional space. And there are similarities and differences, and there's an awful lot, I think, that both sides can learn from each other. My background before starting Goldeye was in the futures market, so very, very much institutional life and at the International Petroleum Exchange, and then at Reuters. So very deep spread of knowledge across the whole asset class range. So it'd be interesting to see how that can apply to the retail markets.
Hi, everyone. My name is Natalia Hunik. I'm a Chief Revenue Officer at Advanced Markets. Advanced Markets is an institutional liquidity provider and prime of prime. We are exercising a 100% DMA model and offering full product suite in spot, FX, CFDs, commodities, and recently launched single stock CFDs. We are able to take on only institutional clients in Australia and the UK, where we have our regulatory licenses, and we extend liquidity from New York and London. I have been in FX for 10 years. Previously, I worked for a company called Boston Technologies, which pioneered the MT4 bridge space back in 2008. And I've been with Advanced Markets for 5 years now. Advanced Markets has been in business for over 12 years. So that's an impeccable track record in FX. On to.
Good morning, everybody. My name's Craig Davis. I'm the Chief Strategy Advisor for KVB Prime. My background, a bit like yourself, I started in the futures market on life in 1995. When it was open outcry, so screaming and shouting. So I've seen transformation, which at the time was scary, but if you adapt with it, it's good. My career has been pretty much in the institutional space my whole career. One stage interbank markets, dealing bank to bank, and then later was dealing with hedge funds and corporates. My role at KVB is to help them take a more of an institutional path and guide them down the guideway of doing business professionally and institutionally, and I'm there to try and help them on their journey. Thank you.
Fantastic. Well, thanks very much, everyone. Let's get started then. So one of the key topics, and this comes up quite a lot, particularly in the institutional sphere, is what we call TCA, or transaction cost analysis. And I must declare I have an interest here because our data analysis firm helps people understand their transaction costs, so I'm a little bit biased. But in my view, a clear understanding of your execution performance is an absolute must in today's markets. And I think that's in part being generated, obviously, by MiFID II. There's been an awful lot of momentum from the regulatory side. But now that's kind of out of the way, I think, particularly following the scandals regarding to some of the FX that we've seen, read in the Financial Times in the past. Now that's out of the way, I think there's a much more kind of rigorous approach to understanding execution performance and using data and analysis to really understand that for people to optimize businesses in a world where margins are less easy to come by. So I'd be really interested to hear your views on that and how people are kind of looking at this space in order to kind of drive their businesses forward. Tom, what's that with you?
Yeah, TCA is very interesting, actually, and it's in the institutional world, it's completely endemic. I mean, everybody uses TCA. You wouldn't think of not using TCA. It's quite extraordinary that in the retail world, so many people haven't even heard about it. They sort of do it a bit. They just don't know they're doing it, and they do some sort of analytics, but really they're doing a very light version of TCA. But they should now, with as you say, much less opportunity to make money. They really should be paying much more attention to the sort of tools that you have in the institutional market, the sort of tools that you've built in Fair Exchange, to really look at their execution, because they will not be getting optimal execution if they don't bother.
Yeah, absolutely. Natalia?
Yeah, it's a very interesting topic indeed. Preparing for this panel, I was reading an article on FX Week where Greenwich Associates reported that 54% of institutional traders actually don't do the TCA analysis. I can only imagine what percentage is like in the retail space.
Yeah.
You can probably as well. But to Tom's point and your point about MiFID II, I have a workshop later on RTS reports, and it's really insightful. In fact, the regulator asks brokers to report so much. It's a massive data crunching exercise, and they already go through the effort of putting all the data together, put it in a table, trying to sort it, and you just add one layer on top of that, the analytics. And I'm not really familiar with your product, but if you add another layer on top of it, just analyze it, it really can help them improve.
Yeah.
It's where a lot of people are in the darkness, especially the investors, about what exactly they're paying for transactions,
Sure.
because there's explicit costs, which spreads and commissions, but there's also hidden and slippage, all of that.
Yep.
There's no comprehensive tool that allows the investors to analyze how much transactions are really costing them. There are some on the venue tools. Maybe a broker provides some sort of report, but I think it's very rare, especially in the retail brokerage space.
Why do you think that is so rare? Is it just because people haven't had the appetite? They haven't had the technology? It's been too expensive? Is it a skills issue? Why do you think it's the
From the
drive?
broker's perspective, why
Yeah.
they don't deploy it? Well, I think they have an interest. They probably don't want to disclose how much the real cost is for the client. And this whole transparency is exposing the fact that people, investors, traders will start comparing brokers from one another.
Yep.
I think some companies and platforms already made attempts to do that. I believe in, maybe Tom, you know better, but I believe in MT4 and Medical's website. They do this MT4 signals, and when you do subscribe between the signals to different brokers, they actually show you the analysis, including the hidden costs of execution.
Yep.
But a majority of traders don't deploy it. Majority of brokers don't have it.
Understood,
Yeah.
yeah. Craig, what's your thoughts?
I think everyone on the panel said the same thing. I look at it as a tool to show transparency to the customer. Obviously, we work in a competitive world. Every broker says, I'm good at this, I'm good at that. I believe if the retail brokers show that it's an extra USP to the business. Obviously, you mentioned the point about the comments from Greenwich. I agree, 54% of the big institutions are not using TCA. Will the retail market use it? But I still just think it's a value-added tool which should be added into the market. And if I was a retail client, I'm naturally going to go to a broker who I believe is more transparent. And I think in the long run, it makes you more competitive, and I think you'll get more business. So, for example, I've seen over the years, every year where you see brokerage cuts from banks, at the end of the year, our business went up. Yeah. It just evolves and grows.
It's a really interesting point you make about it's not necessarily a kind of a regulatory imperative, although there is that, of course, and it's not necessarily just an internal thing. It's actually becoming a sales tool to win more business, showing you're proactive and on the front foot and using transparency and data. This is why you should trade with because on X, Y, Z. Do you see that dynamic playing out in your business?
Yeah, absolutely. I mean, if you look at it kind of plays into the marketing role. Yeah. And if you look at marketing so far, the marketing that retail brokerages have done, it's very aggressive. It doesn't really articulate the value proposition. Yeah. What it was articulating is, come here, I'll pay you the bonus, right? It really wasn't, paying attention, marketing is not paying attention to this unique selling point, which it could be. Yeah. It's going to cost you less if you trade with us. Yeah. I absolutely see that as hopefully the next thing that brokers will be looking at to differentiate themselves.
Of course.
Because in light of this, more transparency, more regulatory disclosure, they really need to find new ways to enhance their value proposition to the customer.
And perhaps move the conversation beyond just what are your spreads, which seems to be the kind of key. Tom, you want to speak on?
Yeah, so I think one of the reasons that retail brokers didn't provide TCA is because they couldn't access that type of technology, because most of the buy-side market used TCA provided from the sell side. It's given to them. So if you're a retail broker who you have no connection with the bank because you're using a prime of prime, where do you get access to that type of technology? You'll have some form of analytics that sort of is a little bit like TCA, but until now, that's really become quite difficult. And so vendors like us, vendors like Goldo, are starting to bring the TCA functionality that you would see in the institutional world into the retail products and to bring those benefits. And I think you'll start seeing more and more people doing that so that they can access that. Because it is, as Natalia says, it's really, really important that that brokers can have an edge rather than just what's my spread at the top of the book. There needs to be so much more in there.
Yeah, there's obviously a lot more to look at as well. Of course, there's market impact you've talked about, Natalia, there's rejection rates or cost of rejections, last look, which is a big thing in the market. I mean, there's tons of different things that people really should be probably looking at.
Right, yeah, and to just expand on what Tom just said is, it's rare in the institutional space or retail that the broker will trade with just one provider, right?
Yep.
So even though, in the institutional space, the sell side provides some analytical tools, that's just nearly not enough, because how do you compare, different venues that, you're trading with?
I'm glad you mentioned that, because that brings me on to our next point, which is about aggregation. Now, obviously, in the institutional space, that's very, 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 very widespread, and you're used to, as a bank, you're used to being aggregated with plenty of other banks. And indeed, I would argue that the end retail clients have probably been the most direct beneficiaries of that. I mean, we all know about Japanese retail traders getting the tightest spreads of anyone in the world, bar none, which seems a slight inversion of the traditional wholesale retail kind of market model. What are your views on the impact of aggregation in general? Has it been a good thing for the market? Are there any downsides to it? Craig?
Aggregation, I like to call it liquidity management. Obviously, as a customer, you can't just rely on one person for a price. You have to have diversification. Under MiFID, you have to ask 5 people anyway. So, for example, I've just seen Ian walk through here. I've had relationships with direct banks. Every bank wants to quote you. To me, we have tried it in the past. Aggregation did go on. I wouldn't aggregate. One, the marketplace knows it's being done. It's more about talking to your customer. So most people would say, yeah, everyone could quote you euro, dollar, and a million, it's fine. But it's going to specific pairs. So, for example, if you're going to do dollar yen, you go to certain banks, they're very strong in dollar yen. If we've got a customer who's very into EM, I know that a certain Aussie bank is not the right person to go for. So I find you have to have aggregation, so you've got diversity to go to, because one day someone price is bad, someone price is wrong. But it's actually about the liquidity management, speaking to the LP, telling them what kind of business you do. Am I trading lots of 1 million tickets? Am I coming in trading 10 million 5 times an hour? So I find that's the much more important part. Rather than the aggregation, I wouldn't just smack everybody. And if someone needs to buy 1 million, why would I pick up 10, 100,000? I don't see the value in it, and it's not going to help my relationship with the liquidity provider.
Sure. Tom?
So it depends on the type of customer. So a prime of prime will almost certainly need to aggregate, because they've got to get liquidity from the ultimate source. But a retail broker, it really doesn't make sense for them to aggregate multiple prime of primes, because there's so much recycled liquidity going on there. It's a false price they're seeing. But what they do need to have is a proper conversation with their liquidity provider about the type of clients they're going to be sending to them. Because we've seen plenty of times where they will lie, it's probably slightly strong, but they will be honest with the truth with their LP about the type of flow that's going to send to them. And they think that the LP will just take it and just accept that this horrible toxic stuff is coming at them. Now, if that's not the right sort of thing, they'll get turned off pretty quickly. Yeah. So you've got to have a pretty honest conversation. But you will need a primary and secondary feed, because technology has problems sometimes.
Redundancy, of course.
So you need some redundancy anyway. So you've got to have, and some LPs are better for different asset classes than others. You wouldn't go to an LP necessarily for the same crypto and your FX products. So you might choose a number of different LPs with primary and secondary to help bring everything together. And liquidity management is the right term for that. Some people, it might be aggregation, let's say, in the prime of prime, but in retail broker, I don't think so, no.
Natalia, you sit in the middle. Obviously, you've got a whole bunch of LPs and you've got a whole bunch of clients.
Right. Yeah, I'm on the front line for this, so I can definitely second what Tom just said about, does it make sense to aggregate multiple prime of prime? And it's exactly right. For the reason that he's outlined, recycling of liquidity. The second one is really just not, cost efficient for the brokerage. It's really not. I mean, when we aggregate, we have UBS to sell transactions. They, provide operational efficiency, cost efficiency, margin utilization efficiency. When you do that as a retail broker, you really don't have any of that. You have to post margin in 2 different places. You have to pay swaps in 2 different places. You have to pay spreads in 2 different places. I mean, and that just kind of ties back again at the cost analysis. I think it was a big talk in town a couple years ago that everyone is going to aggregate, until they started doing that. And after some time, they realized it actually costs them more.
In terms of roll costs and margin and all that
Yeah,
stuff.
because you keep in the margin. There's no margin efficiency. There's no operational efficiency. You actually have extra work to do to settle transactions on your own because you don't have a prime broker to do that for you. So it actually ends up being more costly for you than doesn't really bring any benefit. If I'm a prime of prime, I already have all the banks and I already aggregate them. Why would you need another one that does the same thing?
Yeah,
You just get other issues like double hits and
But I guess also the challenge is if you've got great liquidity, which is taken from multiple liquidity providers, I assume, and your competitors have the same thing, and you're all chasing business which is used to insanely tight spreads on mobile phones or whatever it is. How do you differentiate yourself in that business and win business that can be monetized?
Yeah, absolutely. I think the differentiation is just value, the value that we provide, and it may look on the surface that we're all the same, but really we are not. I mean, I know for a fact that Advanced Markets is just one of the very few providers out there that actually provides 100% DMA execution, and we stand behind it. We've been always exercising this model. You can see that in our reports. You can see that in disclosures that we provide to you post-execution. But with other people, you may not get that. Client will pick whatever is appealing to him. Whether he's looking for a market maker, to warehouse the flow and get something back, or he has a different type of client that is looking to execute larger tickets, they're looking for quality execution, looking to get done, is agnostic to the type of flow that they're sending down the pipe. You talk to us, but depending on the type of clients, and sometimes it makes sense, like was already mentioned about the way that you manage your liquidity. You of course can manage it based on the currency pair and where the LP is strong, but also you can manage it based on your clients. There are clients that are good to send to one type of provider, and there are other clients that are good to be sent to another type of provider. For that reason, you're not limited to one. It's just the aggregating of the two. It's not probably the best option.
Of course, of course. On the subject of kind of aggregation technology and kind of risk management, and this is maybe less in your specific area, Natalia, because of your pass-through model, but in the big banks, they'll run risk books that will decompose flow into individual currencies, and they will just hedge those out. They'll have certain time horizons they're looking at, but they'll have quite complex algorithms to decide how they want to manage their risk. And when people talk about risk management in the broker space, there's obviously a lot of chat about A book versus B book. And they're kind of two look like quite separate models. Tom, what's your view on how risk management is changing in the broker space? Is it moving beyond the traditional A book, B book model? Are people starting to look at things slightly more at a deeper level using technology?
They should. They are starting to look. They're not doing enough yet. Originally, when I started at ODL Securities, everything was B-book, and you just crossed your fingers and you just hoped you weren't going to go under before you made enough money, and you just ran it day to day to day. Then you moved to more of a hybrid model, and then an awful lot became pure A-book. And then some of them thought, well, I'm not making enough money, so there was a bit of a swing back to B-book. And then with some of the more unsophisticated brokers, they just wing it quite a lot. And it's really quite surprising when you look at some of the tools that they use, because we have an analytical tool called Visual Edge for this. We look at the tools they use, and it's a spreadsheet they do sometimes and occasionally, and I really see they should be doing an awful lot more. As far as going A-book, B-book, and then sometimes they talk about C-book, which is really a more complicated one where they're holding for a period of time and then they're covering. It's just anything that isn't A-book or B-book. So they should be doing more of that. And I think some of the tech providers, like I was talking to our partners Mahi, who have a whole product suite they're now just technology that manages that. So rather than A-book or B-book, you send it to their technology and it looks at it, runs it for a certain time, runs all sorts of algos, and increases the profitability that you would have on either. And I think there is definite demand for that. And it's a way that the institutional would run anyway. It's more like a bank will run rather than just running as I hope it's going to be okay.
Yeah, it's a portfolio risk model.
Yeah, it's rather than, sometimes the retail brokers will say if it's below a certain size, then I'll just B-book it, which is ludicrous to me because the client will work this out pretty quickly and just trade lots of small tickets.
So that's a technology challenge, of course. People need access to this technology to be able to do that. But it's also a staffing one, isn't it? Because running that sort of model requires a different skill set to what you might find traditionally in a broker, where you say, oh, that client's difficult, let's put them on the A book, or these guys lose money, we'll put them on the B book.
Very much so, and I think probably accessing that type of skills is really hard. Trying to employ people like that. I guess you could get people out of banks, but is the broker going to be able to pay enough money to the ex-bank risk manager who was probably earning a ton of money?
Yeah.
So it's probably quite difficult. So maybe that will become more outsourced, where you can buy that service as a service.
Yeah, interesting. Craig?
No, I agree. I actually think at the moment there's actually some good people you can pick up from banks. I've got some very good friends who they covered me for 10 years on sales desk at banks, and I'll be honest with you, I think they're fantastic. I'd hire them tomorrow. Just maybe they're called old now, but I don't think they are. And these guys, I'd hire them tomorrow. So I actually see it as an opportunity where there's someone who isn't working in the bank anymore getting the big salary they were used to and the annual bonus. Yeah. They need to have a job. Would you like to come and join us and grow a business? So I actually see that as an opportunity. I think in a bull market, everyone's hiring. It's quite hard to get staff. Yeah, so I'm actually quite positive that I can find some good bank staff who would, in the old days, have sat in a bank. Would you like to come to the broking side and develop that part of the business? So I'm quite positive on that part.
Sure. Natalia?
Just to add to what's been already said, I mean, I see everything that's been already described. Outsourcing of the B-book, doing it in-house, automating it. There are tools out there that allows the brokers to automate it, but as Tom mentioned, I think for the most part, it's really not sophisticated. For the most part, there is this disclosure that everyone puts on the website now, the percentage of traders that lose money. I think that's the model.
Yeah. Sure. Data sharing. We're hearing a lot about data. Have you seen The Great Hack, the Netflix film about Cambridge Analytica? They said that data is now the world's most valuable asset. It exceeded oil in global value last year, which is an amazing thing just to kind of reflect on for a minute. And data sharing in the institutional space is associated with people going to jail. It's people sharing information in chat rooms. It's banks being fined billions for doing something improper. And of course, it makes your former clients and the guys you used to work with very nervous, particularly when positioning is being shared. Hedge funds absolutely hate the idea anyone could possibly know how they're going to be trading. The broker market seems to be very different in terms of data sharing, because we've seen mirror trading, for instance. That's a very well-established model where people are publicizing how they're trading. Is data sharing something you think is going to increase in the next few years in this world? Is it something that people want to do more of, peer universe analysis, that sort of thing?
Okay, I think that there is some degree of data sharing happening in the retail FX. However, you have things like GDPR here in Europe and other regulatory changes that are probably going to limit the extent of it. In terms of data sharing in the equity space, equities brokerage, I mean, it's happening, right? I mean, that's an additional revenue stream for the stock brokerage, share the data with the hedge fund, right? I mean, they sell it. Robinhood, great example, they sell it. With retail, I think it's happening. I mean, it's happening, but probably for a larger brokerages, they are selling the data to the institutional space. In terms of personal data sharing for the clients, I think globally the regulators have taken a stance on it. And example is Google, Facebook. I mean, I think it's probably going to come to the financial space as well, the retail financial space.
Tom, do you think looking at your data, your trading data in a much broader context of other people's is helpful?
Absolutely. I think that's really interesting, especially when you've got someone like us with a very large data set. As long as it's purely anonymized and you're looking at statistical information coming out of that, you can see some really interesting trends. So yes, I think that's and I think that is a growth area. But also completely agree that data is more valuable than anything else in the world. I mean, it's how Google functions, isn't it, how they started.
And people seem to be waking up to the value of that data, and whereas before it was just a thing that technology produced, now it's actually something that really needs to be exploited.
Absolutely. I mean, I was looking at a company called Crux in the States, which is backed by, I think Morgan Stanley's one of the backers, and Citibank, which is all about data collection, aggregation, and dissemination to different people. It is just enormous. It's just enormous. So yes, I think that's, I mean, you could get to the point where trading is free because the data has more value than actually charging for the transactional costs.
Sure, but then it's back to the thing about if the thing's free, then you're the product, I suppose.
Yes, I mean, I was talking to my wife about Gmail. She said, "Oh, it's great, isn't it?" I said, "Well, it's free because they're mining your data." And really, really? I said, "Yes." I think people don't always realise that they are mining data, but I think that's the difference where you've got personally identifiable information, which really is very different from anonymised information, which is. If it's personally identified and you get an ad, I mean, the number of times we've been talking about things in the office and you start seeing ads appearing, you think, I didn't even type it, I just spoke it. Yeah. How did it know?
We talked a little bit about regulation and kind of oversight of the market, and of course the FX Global Code is something which has been certainly very well publicised in the institutional space. And I think maybe part of the reason for that was that I think there was a misperception that FX wasn't regulated, actually in the technical sense of the word, in the way that exchange-traded products were. And the FX Global Code was probably an attempt to try and fill that gap, and is very well known across all the banks, and lots of banks are signing up to it, and so on and so forth, and it's all at the FT. I sense the retail space is very different because everything I hear about the broker space is it's regulated up to the eyeballs and it couldn't take any more regulation. Of course, it's treated differently because it's classified as a CFD. And maybe the FX Global Code, therefore, doesn't have so much relevance for brokers, or does it?
Well, I was reading it yesterday, actually, to get up to speed on it for the panel. And it does actually say in there that this applies to retail brokers. They have a specific line they put in there to make sure they did realise that it should apply to them and they should sign up to it. I think they should. But the problem is that about 90% of the brokers in the world would not meet the criterion.
Right.
Some of the openness that it encourages, I think they probably wouldn't like. I think they should. I think it's a positive thing, and I think everybody should sign up to it. And we were approached by them to sign up to it as a tech provider, and I originally didn't realise that you could, but you can as a tech provider. And it's something that we're going to look at and look to do, because I think it's a really positive approach that everybody knows the rules they're playing on, and it's a fair market.
Natalia, is this something you guys have looked at?
Yes, absolutely. Advanced Markets is one of the first, adapts of global code of conduct. But I agree with Tom. I think for 90% of those are the standards that we live by the way, every day. So, we signed once we saw the global code of conduct coming out. Everyone in the office read it, and we just thought that this is what we do on a daily basis.
It's just a no-brainer.
Of course, we signed it right away. But to Tom's point, I think for a lot of institutions out there, in the retail space, I mean, it's just not the level of transparency they could currently support.
Yep.
And it is absolutely relevant. And in the EU, with the new changes in the regulation, perhaps that's going to all the transparency and all the disclosures that they have to do. I mean, it's perhaps they're going to be all signing up for the global code of conduct very shortly.
Sure, absolutely. Craig, any views?
I'm very pro. Obviously, myself personally, I would happily sit down with other, you call them competitors, and sit together at a table, and I'd be very happy to sign up to the code because, as Tom said, it's a level playing field, and then I believe Walter will meet its own level, so then the customer has a choice. If there's 50 people in the marketplace and 10 people sign up, well, I would probably go to one of those 10. So I believe in transparency, and I believe by being transparent in the end, you'll do more business and be more successful.
Okay.
That's my ethos.
Just to wrap things up then, we talked about what the broker space can learn from the institutional sphere, but a final question for you guys is, flip the question on its head. What do you think the institutional space can learn from brokers, if anything?
I think automation. Retail has, because of the number of traders, you have to automate absolutely everything. You couldn't have the idea of a phone-based retail broker really with hundreds of thousands of people ringing in. It just doesn't work. And so we've had to automate for retail brokers absolutely everything, and the number of transactions per second, the size is absolutely massive. So if you take that into the institutional space and you say, if you look at swaps, which is huge, but very poorly automated, so much of it is still phone-based. That's where the automation can come in, and you can use the same type of technology adapted, which is what we're doing actually, for that type of market. And it will be, there'll be some problems with people who don't want to automate it because they make a living out of doing it on the phone. But once that's overcome, a bit like getting rid of the trading floors. I was on the live floor as well. I did the first automated system to replace the traders screaming at each other. we weren't terribly popular.
Yeah, sure.
So I think that's where it can help. That's where retail can help.
Any final thoughts, Natalia?
Yeah, absolutely. I think Tom is right about automation, and I think in general, retail space is just much more innovative. It's flexible, it moves very fast, which I cannot say about the traditional space, right? So you see how, in the institutional space, there are technology pieces and platforms that are just becoming irrelevant over time because they just fail to adapt to the challenging environment. And the environment is ever challenging because, of course, the big market, black swan events are not only impacting retail, they're also impacting institutional. But retail seems to be just a little bit more flexible in the way they pivot, the business model, in the way that they adopt the new technology tools, whereas institutional space is much slower.
I remember being at Morgan Stanley being very jealous of all the retail guys who had amazing apps on their phones, and we didn't have one.
Absolutely. I mean, then if you walk around the floor, you'll find so many different technology solutions for every problem you might have as a retail broker.
Sure.
And they're happening very quickly.
Sure.
And just able to innovate very quickly, which is very important. And the retail industry, as you said, it's regulated to the eyeballs, and it's really tough to operate on the squeezed profit margin.
Sure.
So you need to adopt a lot more technology, a lot more automation, and you can see that happening very fast in the retail space.
Thanks. Last thought, Craig?
I'm very pro-technology. As I said, the beginning of my career was open outcry. I remember leaving life and escaping to Singapore and going on Cymex for Exodus. And I kept on doing that for 5 years. And then suddenly I start looking at trading platforms, and actually you realize you can do more business, you can be more successful, you can have post-trade analysis, you can have data. It makes everything easier, so you shouldn't be scared of technology. It's about looking at the institutional technology, the retail technology, and creating a hybrid together.
Fantastic. Have we got any time for questions? A couple of minutes. Do we have any questions from anyone in the audience for our panel? Yes. I think there's a microphone coming over to you.
Hi there. Question to Tom probably. You mentioned that data is kind of becoming one of the most valuable assets. So just curious, maybe you could provide some specific examples of what kind of statistical data you look at, where do you see most value in that data? Because there's so much data, but maybe some specific examples. What's valuable for you guys?
Well, it's not the price data because that's very easily accessible. It's more trade data that has never hit the market. So B-book information. So where you've got a whole load of people trading on a sentiment that is not hitting the market, and you bring all that together, if you've got enough sources to bring it together, you can see some statistically important trends coming out of that. It's very difficult with a hedge fund because they'll never tell you how they found the alpha. They'll look at something and say, we have found alpha, this magic thing. But they won't tell you how they found it because that's their secret source. So, but this is where I believe they're finding it.
Any other questions? No? Okay, well, thank you very much for a very enlightening panel. That was
Thank you.
Brilliant. Thanks for your time.